Welcome everybody to the Ides of Macro, episode number 12, and it's my great pleasure and honour to interview Tyler Neville, who I've worked with in the past, have known for many, many years, and always has some absolutely fantastic insights on the macro world. Tyler, welcome.
Thanks, Raj. Happy to be here.
And I know some people might not know who you are. Anyone who's, for instance, watched Real Vision will probably be aware that you were there for some time, but could you give us a bit of your background? Because really what's interesting for this conversation is that what you did before then and now in the post-Real Vision world, because you have been very heavily involved in markets from an institutional perspective to a hedge fund perspective from all different angles. So could you give us a little bit of a rundown of what you've done in this space over the, I won't say too many years?
Yeah, sure. So I started after college and I went to KBW, which is a boutique investment bank that just covers financial companies. And that was really interesting. I started there in 2007, right before the financial crisis, and essentially saw all these non-performing assets. I saw like the whole world of Wall Street kind of implode before my eyes, and all these people were printing money and had no idea what was going on. So, KBW was one of the first banks to call it a recession in 2008. And I got a real good background there of how banks work, how financial companies work, et cetera. And one of the interesting things we'll get into later is like a lot of the guys from KBW during that time actually were one of the first people that ended up in like Bitcoin and crypto, because they understood how the banking system worked and followed the evolution of kind of the end game of what we're seeing here. And so that was my first job. And then I went to a hedge fund in Miami called HIG Capital. It was a private equity firm that had a public hedge fund at the time. And we were short some financials on the way down, but missed the rally on the way up once they started printing money. And then I was at a variety of other hedge funds, one in Boston, and then one activist fund out in California called Mercado. It was like a Bill Ackman spinoff run by a guy named Mick McGuire, super smart. And then I worked at Real Vision for a couple of years as well, because I really just love interacting with the financial crowd and learning new ideas from people all over the world. So and that's a bit of my background. Now I'm at Corriente Advisors, which is a firm run by Mark Hart, who is probably most famous for shorting the subprime crisis in 2008. He bought credit default swaps on Greek debt in like 2010. And was one of the first macro investors in Bitcoin, I think in like 2015, 2016. So he's been on the front ends of a lot of change, and I'm learning from him. It's been an absolute pleasure.
And I'd love to get into this, because what I always found fascinating is people who, from an investment perspective, can have maybe a very clear path, but then change that path as they see the world change. And I think this is something which you've understood as well. I'd love to get into this sort of idea of how you think our investment landscape is ultimately changing at the moment, because one of the things you've talked about is this sort of decentralized versus centralized, and people think of DeFi, decentralized finance, but I think I'd love to hear your kind of framework, because it's not a DeFi framework, it's actually a kind of a global framework of this thing is changing, and it's changing from a political, geopolitical perspective to an actual investment perspective to a demographic perspective. I'd love to understand that basic overall, and then we'll sort of dig down into it from there.
Yeah. A lot of my decentralized or centralized framework comes from, I worked at a company called Franklin Templeton for a couple of years as well, I forgot to mention. And Franklin is this behemoth company. It's about $1 trillion in assets plus now. And what I saw there was essentially like the demographic boom of asset management, and they have like all these assets, $1 trillion of assets, and they're like giant aircraft carriers, right? And so working at a spot like that, it's like really hard to keep growing when you're $1 trillion. It's like any other giant tech company where it's like pretty hard to keep growing and growing and growing ad infinitum. These things have grown like rocket ships for the past 15 years. They've cornered the market on assets, and they don't sell when an asset is overvalued. They just hold it. So it creates kind of these funky side effects for markets, which we're seeing right now, which is, the floats get smaller and smaller, and every incremental dollar that goes into the market kind of creates maybe like a more of an asymmetric move higher. So the point about decentralization versus decentralization is essentially that, you know, these giant companies, these asset managers have grown so big. Now they have to find new frontiers to invest because they've cornered the asset. They bought the Austria 100-year bond at 0.85% negative real yield. They now that bond is trading at 43 cents on the dollar. They were trying to find all these frontiers and invest in China, which is now, we're deglobalizing and all that money is coming out of China. And so you have to basically invest on new frontiers. And that's the decentralized world, as I put it, which is, higher volatility, but you should theoretically get paid a lot more coming out of that.
And so what you're talking about there with the sort of passive world, I guess, in some ways I think from what I've sort of read about this and seen people talk about it, feels like that in the world as it's got narrower and narrower, and I think we've now switched in the US to it's more percentage of assets are now passively managed than they are actively managed. Even though trading might still be much more in the active sort of mindset, the actual assets themselves have shifted. And it's kind of one of the distortions that seems to have created is that, let's say, I'm making these numbers up, but let's say 30 years ago, $1 into the market pushed the value of the market up by $2. In this world, $1 might have pushed up by $5. So you've got this effectively this ballooning of market cap of certainly some of these tech companies, which are the big cap stocks and these passive funds or the indices. But actually, they're moving further up per dollar coming in than they would have 30 years ago. Is that right? Because it's all this concentration that we've been seeing in that passive industry.
Correct. And it's a lot of market structure issues. They're not programmed to sell if something's overvalued. The supply doesn't come to the market, right? So it can kind of choke the float on a lot of these stocks. Like what we're seeing in NVIDIA, perhaps, is you could say it's fundamental. They're growing hand over fist. But, it could also be a share count thing where, it just keeps getting squeezed and squeezed as money flows into the ETFs. And then you have, potential gamma effect where if the Wall Street Bets crowd realizes, NVIDIA, the float is choked and they buy deep out of the money calls, could that cause, a gamma squeeze? This has all, created a massive centralization problem. What breaks that generally is inflation. And then you have to raise rates. And, if oil prices hit 100, you might change your tune. But for now, as long as inflation's coming down, rates have not spiked, the Fed saying, this is probably the end of the tightening cycle, those dollars are still flowing back in. And we're also seeing, money market funds and CDs have about $8.8 trillion of cash. You could probably make the argument that there's a cash bubble here where, everyone went to cash in 2022 and got very afraid. 2022 might have priced in the recession that we're potentially could see down the line. Or this could be a massive productivity boom, which is what you'd expect when everyone's in cash is what's going to hurt the most amount of people is a massive productivity boom and the market screaming to new highs, which is kind of what we're seeing here.
And that kind of brings on to, because that's a really essential point here, is because cash on the sidelines is not really on the sidelines because it comes into the market, buys something and buys it off people who then put the cash effectively on the sidelines. But what does matter, which you alluded to there, is who's the aggressor? If the cash on the sidelines is a much more aggressive buyer than the people that they're buying from, then the markets will go up. But if we've got a recession, it might be that the sellers currently in the market are more aggressive sellers than the buyers who are sitting on the sidelines. But it's still a swap over. But what really matters is who's the angry buyer and who's the angry seller is going to define whether we have a bull market or a bear market. And you say at the moment, it doesn't feel particularly recessionary. I mean, I've been predicting a recession for 2 years now, and it's just not happening yet. And unemployment, at these levels, it needs to scream higher to be in a recessionary environment.
Yeah. I mean, that's what's confounded a lot of people, which is, I think it probably was priced in 2022 as the recession. It probably overshot to the downside. And now, the market's just incrementally taking that incremental dollar and creating this kind of, you could call it a short squeeze, but I mean, productivity is going up. Like Bill Gates said the other day, software programmers are becoming 50% more productive. So that should flow into corporate earnings, right? And you have, this plentiful amount of cash on the sideline. As long as rates don't spike and there's no credit issues, there's no, massive inflation in oil, then, this could keep going.
And do you think there, because one of the probably key points with all of this is that for a programmer, productivity will go up, but there might be fewer of them. So overall productivity at the national level may be relatively static, but a few people become a lot more productive through robotics, through technology. But a lot of people might lose their jobs. So you get this inequality. Do you think that's going to be one of the risks that we see? Because ultimately, whether we have everybody benefiting or just a few people benefiting and people effectively getting sidelined, kind of double-edged sword, less pressure on wages from those people because they're out of the labour force, fewer people with all the capital and therefore the spending power. Do you think that there's going to be, do you think this is part and parcel of the problem, is that sort of imbalance, that sort of inequality which people say they're going to address actually might get worse before it's properly addressed? And when it gets addressed, it'll be addressed by fiscal policies, which tend to be much more inflationary than it will be by monetary policy. Because this seems to be one of the big battlegrounds going forward. Is an inflationary mindset right because of these imbalances, or is a deflationary mindset right because technology and productivity improves things?
Yeah, that's the $1 trillion question. It's largely political, right? If you have, the haves and the have-nots, we're probably in a larger cycle from capital to labor, and we're running $2 trillion deficits right now. So everyone wasn't expecting nominal GDP to be as high as it was, but that's what you get when you're deficit financing. It's and that could keep going. The thing is, we're producing. No one gives Biden credit, but the U.S. is producing the most amount of oil it ever has. So, has that kept a lid on WTI? Yeah, I guess it has. And as long as that happens, the U.S. can innovate better than the rest of the world right now. But to answer your question, I think it's on a longer time frame. Yes, you'll probably have labor issues and fiscal where you have to actually force government programs into certain parts of the economy to make people more productive. But we haven't seen unemployment spike yet. That's the thing. This could be massively productive. There's a lot of different productive things going on, which is the labor force is getting more productive. No one's getting fired just yet. You've seen large tech companies have some layoffs, but on a macro level, it's not really happening. Then look at an industrial company like Fastly is at a new high, and we don't own any of these things. We don't own Nvidia or Fastly, just to caveat it. But it's an interesting example of what's going on in the market. Is these things are making new highs and everyone's still bearish. It's kind of fascinating.
Yeah, that's always been the case, and it's interesting as well, because one of the things which I'm trying to work out is, let's call them the Magnificent Seven, as it's six now, but whatever those Magnificent Seven are, it's been very interesting because obviously when we had that re-rating as yields went up, we saw all the tech companies coming under pressure in 2022. But then there's that sort of light bulb moment where I think a lot of people went, hang on a minute, these big tech companies all have cash, lots of cash, which at 6% interest rates or 5% interest rates earns them loads of money. So higher interest rates for this group of stocks, so stocks with low debt and high cash piles, is good. And then you go, but then there could be the slowdown environment. Well, actually lower bond yields is actually good for the growth stocks, of which these tech companies are, again, growth stocks. So it's kind of winner takes it all. It feels like, as you say, it's the inflation story that's got to rear its ugly head. Now, at the moment, everyone's pricing in, the Fed's pricing in 3, the market tried to price in 6 rate cuts for 2024. Do you think that in this environment we're talking about, the risk is actually that the Fed sit there going, well, hang on a minute, equity market higher, unemployment under 4%. Our bias should be to raise rates, not cut rates. So therefore, we're going to do nothing, because actually if we can raise rates and the equity market can go up more and unemployment can stay at 4% or under, surely they'd actually want to do that. And so isn't the risk here that actually this scenario of things look good with a starting point of where we are actually increases the chance that we get a surprise from the policymakers, that actually their bias towards cutting disappears and actually we start to reprice higher?
Yeah, I could see that, but look, the break evens, I'm just checking out now. 2-year break evens are at 2.3%. There's really no reason for them to raise rates anymore. They're right in the range of their policy. So I don't know. They would probably risk having more deflation than what the bond market is saying right now. one year break evens are at 2.5, 2 year break evens are at 2.3, and I don't know, until you see a real spike in oil, which is possible. I don't
But
know. I
then,
don't.
I suppose the argument, it's like the Julian Brigden argument, which is the financialization, which is that if the equity market goes up, they will hoard, stroke, hire more people. There is a potential risk that that's when you might start to get true wage inflation coming through, a sticky wage inflation. So the danger is that what we all want is a higher equity market, but actually a higher equity market might be something that then allows inflation to rebound from wages, which is far stickier than from commodities, which is always cyclical.
Mhm.
So I guess is that maybe the risk here is that we actually, things have been so good and things have ridden out. We've had this rolling recession rather than a true coincidental recession of everything together. That actually, the risk is that corporates just go, well, that's pretty good. Starting from under 4% unemployment and 3% inflation, that risks that we've based in inflation.
Yeah, I mean, it's looking like we're basing an inflation right here, and I don't see, if they lower rates, things could get probably a little bit more overheated, but it seems pretty stable right now, and I think the market's telling you that. The VIX is kind of been flatlined for a little while, and credit default swaps, CDS on high yield has been, very moderate. Inflows into bonds have been great. Um, so there's nothing really signifying, a credit event. There's some things to worry about, which is commercial real estate. That's definitely a worry. But here's the flip side of commercial real estate that no one talks about, which is, if I'm spending 20% less money on my office space, that's a massive productivity boom. So like the NPAs on bank balance sheets for commercial real estate, the flip side of that is maybe the FANG stocks make 20% more money or whatever it is. It could go follow just to a different sector. To your point, the haves and have-nots. You got to pick the right sectors to be in a productivity boom. So, I think we're seeing the denouement of commercial real estate. Will probably be cities that do fine. Like you're going to get one of our giant themes is the exodus of people from the coasts to places like Texas and Tennessee and Florida because it's just a giant tax arbitrage, and you have these pensions that are unfunded on the coasts, and you have this $30 billion surplus in Texas, and you have to compete for taxpayers, right? So everyone is moving to these states because cost of living is lower. There's a productivity boom for Texas. So my point is there are going to be winners and losers in that world, but for every commercial real estate bust, there's a company that has people working from home and making 20% more money than they would have in a building. I mean, I work from home most of the time, and then I go up to Fort Worth to the office. But it's it's a great added benefit to your business.
And you were talking about that effectively in the US kind of sphere, talking about these sort of movements. There's one of the big arguments, I guess, on this decentralization versus centralization argument is that at the very, very highest level, we've seen people say peak globalization, and everyone talks about that as a negative. It's like, oh, all the benefits of globalization are over. But just as you were saying, there are massive benefits in places like Texas. Do you think, and I don't know if you're thinking about this in your funds, but are you thinking on a global basis that if we've seen peak globalization in terms of convergence, divergence probably will create some great opportunities as well. So rather than just saying it's all negative, it's actually, do we see a reshoring in the US? If there's a reshoring in the US, does that mean that Latin America becomes a really, really exciting place? I've been looking at Japan a lot over the last 2 years with and just saying, I like Japan. And here we are at the highest level since the very early 1990s. It feels like that's where this automation and productivity boom has been playing out, forced on them by demographics. Do you see some pockets of opportunity occurring on a global basis where we might get reshoring, we might get regionalization, so that actually, rather than being negative about peak globalization, we can actually maybe be excited by some of these regional opportunities?
Absolutely. I mean, Japan's a perfect example. It's going, was it 30-year bear market or something, and just coming out of that, and all these companies are dirt cheap. Not only that, but there's a tail risk to Japan, which is China, obviously, but you do have you do have an incentive. The allied world is realigning itself, and I think you're either pro-Western culture or you're not pro-Western culture. And look at Argentina. That's another great example of like, they're reforming that. It's great natural resources down there. And a lot of now it's pro-capitalist with Milei. And you're seeing inflows there. So the point of the centralization versus decentralization is there's going to be monster opportunities. Active management should be able to kill it. Like they should relatively, if you're in the right spots, the whole beta neutral hedge fund model should really underperform here for the next couple of years. And I've seen that. I've worked in those spots, and it's great. These guys have the edge on all the information, the best tech. They have 40 billion in assets, but like, I think if you're smaller, if you're a jet plane and you're decentralized, I think that's probably going to be a better business model going forward in the next 10 years.
And I've always thought, one of the arguments I've made recently is that people should look at active managers in the same way that they look at optionality, which is, maybe put 50%, 60% of your portfolio into an index or a fund or whatever. But then in the same way you might have 1, 2, 3% in Bitcoin, have 20% in an active manager who you hope is uncorrelated to the S&P 500. Because what you want is when the S&P's going up 10, 15%, you've got your passive fund and hopefully you'll get some of that. But then you might get these 2, 3x returns in the big uncorrelated moves that might happen. It feels that what we've been seeing over the last 10 years, and I'm plugging obviously active managers here, but it feels like everyone's just gone, take my brain out, go passive. The danger with that is now everything's correlated. Well, actually, you need to look for those uncorrelated returns, which is effectively what you're saying here. Go decentralized, because if you get these assets, these pockets of opportunity, these can be not your 10%ers, but your 10x's, your 20x's, stuff like that.
Yeah, well, there's actually different ways to look at it, but like the risk might actually be holding the same thing that everyone else is holding, right? Here's an interesting generational example, but like, have you heard of this guy, Mr. Beast?
He's on Twitter, isn't he? And the big YouTube's biggest person.
YouTube personality, and
yes.
He gets about, I think it's 1 billion views a month, and the ad dollars he basically produces from this is astronomical. Like you would not believe, and on the surface, this sounds ridiculous. It's like, this guy is a new institution. We're moving from the fourth turning of mainstream media to the new institutions. They're under our noses. Their growth rates are absolutely shocking. Like this guy he might be the most powerful man in the world, but no one's talking about him. He gets no mainstream publicity, and it's like his Feastables company went from, I think it was 2 million in sales the first year to 200 million in sales like the second year. Something crazy. Like, I don't quote me on those numbers, but it's multiple hundreds of millions. And this guy's one brand. This is happening. This is the decentralization happening before our eyes. And boomers don't see it because they're watching CNN or Fox.
That's right. I mean, I think
there's parts of the market. Bill Gurley says regulation favors the incumbent. You can make the argument that the asset management world has basically stultified innovation and cut off active management from certain pockets of the market that provide better returns. For all weird incentives, and then these pensions have these incentives, but like it creates a better opportunity if you can actually swing the bat. And so I think guys like Mr. Beast realize that. There's countless other examples of this. It's why private markets presents very interesting opportunities, because these oligarch monopolies that are basically like they're death by 1,000 cuts. You're slowly losing money, but it's like the boomer run companies, and the possibility for growth is just not there. Your risk is sitting in a seat like that and working at a company like that, instead of the bigger risk is sitting there for your whole career and getting chopped up by inflation or negative real wages, instead of going to a new company or a new organization like say Mr. Beast.
I mean, I think the editor of the Wall Street Journal was in Davos. This would be last week compared to when we're talking, and said we don't control the news anymore. No. It's basically owned by effectively individuals via these other media outlets. And I guess, look, one of the things I always think, though, is that what drove this is actually having near zero interest rates for so long meant that you could basically hire people. And this is the problem that San Francisco had: is it hired people to do all sorts of weird jobs within the tech industry that they didn't really need. And they found that when Elon Musk cut everybody and X still existed, Twitter still existed, it was like, maybe we've got a little bit too much excess float, as it were, with our companies. But so you don't actually need that. But surely the argument that is maybe the right one is that actually we need interest rates which are high, because one, interest rates that are high disencourages people to add debt. We don't want people to add more debt. That was a problem for the last 15, 20 years. It's like, more debt because it costs nothing to run that debt. Now it does. Now people say, but we can't finance existing debt. There's probably some level of interest rate which keeps us all a bit real. Make sure that we are, we're looking for opportunities where the returns are correct. Because let's face it, over the last 15, 20 years, there have been a lot of companies which probably should never have existed or should never have been on paper as successful as they look from their share prices, given the lack of profitability that they had, but they could just roll their debt and roll their debt. Surely in a world where maybe we have interest rates that reset to maybe a base of, we're 5.25 now, but let's say we rebase at 3.5, isn't that going to be a good thing?
I don't know the answer to that question, but I'd say the debt problems are largely on sovereign balance sheets. They're commercial real estate, regional banks, but they're not. A lot of the corporate debt has been termed out. They're not as in debt as they were, and that's the interesting thing here. Is like you have these perma bears calling for credit crises on corporate debt. No offense, Raj. I'm just kidding.
I'm not a perma bear anymore.
No,
I haven't been for at least 3 weeks.
Yeah, but yeah, it's could that come back if you have a deglobalizing event or a war? That's always a risk that you have to take into consideration. It's worth looking at Taiwan Semi as a stock, as a giant geopolitical VIX, where it's like if China is going to move on Taiwan and cause global ripple effects, that's worth keeping on your radar, because that should kind of heighten the geopolitical risk. I think right now geopolitical risk is underpriced, and that's the one thing where no one the VIX should be higher just off that, but because of the market structure, it's all quantitative and all
everyone's selling vol all the time. Yeah, so the VIX is probably. I think saying to Imran Lakha, who's obviously on Real Vision quite a lot, is saying, is 20 the new 30 on the VIX? I.e., at 20, you're actually giving the same signals from the VIX as at 30, maybe 15 years ago, because you're getting this suppression of volatility from all these structured products. So it's lower than it should be. I mean, it obviously reflects the market, but maybe that's the case. And what is there a way of hedging geopolitical risk? Because in 25 years of covering clients, the one thing that was always the best losing trade was trying to hedge out geopolitical risk, because you don't know it's going to happen. It slaps you in the face, generally from the left field, and you didn't know it was going to happen, which is why it's a geopolitical risk. And some people say, well, you just got to buy, 1 delta puts the whole time, or 5 delta puts, and just roll them and roll them and roll them. But as we all saw in 2017, you do your nuts because you keep on blowing away premium. Is there something in the world out there, and that's not just gold, for instance, that's maybe a decent hedge to geopolitical risk that you can think of?
Well, Bitcoin's an interesting proxy, just because if you see the world deglobalizing and Saudis buying Bitcoin, which could potentially happen, this is maybe becoming a reserve asset where, if you've lost money in treasuries for, 2 years and you're a giant sovereign that owns treasuries, and you see the world kind of devolving, Bitcoin could be an interesting way to hedge, given 70% of the holders haven't really sold. And so if you get this, these concentric circles of adoption where, we saw corporate balance sheets start putting it on. Michael Saylor's proven, he outperformed, his stock outperformed holding Bitcoin. So if you get more sovereigns like Bukele is now in the money on his Bitcoin, that this asset could actually turn into a giant. With the problems being on sovereign balance sheets, it's not crazy to say that Bitcoin could turn into a global reserve asset, especially in a world where there's war.
And I guess what with that is the argument for both gold and crypto Bitcoin is that fiat currency story, which is sovereign balance sheets is where it all sits, and most of the big debts in those sovereign balance sheets are people who control their own currency and therefore can kind of, whether they call it printing or not, but basically print with impunity. Because if everybody does the printing, and let's pretend there's only 10 countries in the world, and those were 10 developed countries with 10 currencies, and everybody printed the same amount, actually all the currencies don't really go anywhere apart from versus gold and Bitcoin. And this is what I talk about, that concentration where you treat some of these assets like optionality. You might still have a core in good old fashioned boring traditional assets, but then there's that as you say, on the frontier, the decentralized frontier, where you get these incredible opportunities in volatility. You've got to take the risk, you've got to size it accordingly, but that's where your hedges are to the mundanity of the things that everybody has.
Yeah, correct. And two interesting things that we saw. These are art mimics life, life mimics art. Is Henry Kissinger died and Charlie Munger died. And these are two guys that opened up China and shorted volatility for their whole lives. And that's usually a generational turning point. If we see that could be one of those moments where you say, okay, short vol worked for 40 years as these pensions funded themselves, and baby boomers had all of these structural reinforcing demands for yield. And now, if this is a first turning, if we're on the cusp of a first turning, you're going to want to have these first turning institutions. The risk for the next 10 years as the political tides change, I mean, we're going to have to open up new frontiers if we want to grow, with all the Medicare and all these entitlement things we have. So we're going to have to figure out ways to grow, which is where we think the best place to put your money is actually not just harvesting yield or buying a bond. Is your better risk reward is sitting in something where it could go up 5 or 10x, and there's a massive supply and demand imbalance that's at your back. So that's kind of what we try to hone in on here.
And then in terms of, you talk about the way that you're thinking about this, and I'm thinking now, again, high level sort of sector, macro-y type things, but what do you see as, let's say, those frontiers of decentralization, where the opportunities are? Obviously, you've got Bitcoin and some of the crypto space, but what is the sort of general thinking? Are you kind of going, it is Latin America more than it's Southeast Asia, for instance? It is these tech stocks, not the tech stocks of the Magnificent Seven, because everybody owns those. It's these other opportunities. What sort of themes do you think are going to be, let's say, next 5 to 10 years? So we're talking long term, not about price and entry points and exit points, just the ones that should become the big themes, the cars that replace the horses. What sort of things are you looking at there?
Well, nuclear power is super, super interesting, because I think what we realized with this Russia scenario is everybody needs to be a sovereign on their own, right? You have to be energy efficient on your own. Otherwise, it can derail a lot of your economy. And I think that's why nuclear provides kind of a diversified basket of keeping your cost of capital low as a nation, right? It's the cheapest way to produce energy. And politically, if you have a world war going on, potentially, whether that's a Cold War or kinetic, nuclear will be what gets turned on. That's a frontier, and there's a massive supply and demand balance in there. Utilities are forced buyers of uranium, and they keep turning on. All the politics, one of the interesting things is during World War II, the Manhattan Project was based on nuclear and uranium, right? And these things kind of come back. It's fascinating that we're starting to hear the drums of nuclear again. In the same time as the world is kind of coming to some sort of event here, whether that's China taking Taiwan or some globalized event. And as a nation, you're going to probably have massive subsidies. Kazatomprom is like, I think 40% of uranium supply. If that goes offline, that leaves a basket of stocks in North America that could be very good. So stuff like that is like a first turning institution where it's new. No one's really investing there. It's gone up a lot, but like, have you seen massive institutional flows? Not really. Like, when's the last time you've seen an asset manager pump their uranium fund or nuclear? It takes a while for these things to turn on.
And how do you think we get to the scale? Because I mean, it's just everyone's going to go down that route. Because I think one of the problems has been, if you said to institutions, and I remember doing interviews for Real Vision 2017, 18, 19 on uranium, and that was that period where it was a bull story, but it just went sideways, the price, and then obviously in the last few years it started to move. But for a lot of institutions who want to deploy lots of capital, it's still the eye of the needle. One of the reasons why a lot of the crypto space is still tricksy for a lot of people is that an institution with trillions wants to deploy, a couple of percent of that, and suddenly that would absolutely, not destroy, but some of these small markets would go to the roof. Do you think it's going to be difficult because the uranium story, the nuclear story, it's a very clear story, but it's still a very small story, which actually is a preventative reason for institutions to get properly involved?
These institutions, there's this tectonic shift, and it's not just happening in just Bitcoin or uranium, but like, I think these institutions have grown so large in other parts of the market that now they're forced to invest in the frontiers, because you can't go say, oh, we're going to go, Larry Fink's going to put money in China, because we're not going to incentivize the Chinese, shipbuilding company and put U.S. retiree money there. So they have to find things that are the allied world, that are pro-Western culture, pro-capitalism. And for a while, they weren't really doing that. This was just a sprawl based off of low fees, right? Cutting labor costs, cutting fees on asset management. This was a 40-year cycle. Now it's reversing. And so, yes, uranium, we're probably on the cusp of like, I got to imagine like some asset managers are thinking like, this could be a huge, huge market. Let's start a new fund there. We think, cannabis is a sector of ours that it's, U.S. supply chain based. It's, kids in the next generation don't drink alcohol. They just think, if you look at the polls, it's really an interesting thing but what's kept cannabis basically underinvested is largely the pharma industry, and for every state that comes online for legalized cannabis in the U.S., I think it's like pharma takes a $10 billion hit. So this is all the same thing. It's why Larry Fink decided to do a BlackRock ETF or a Bitcoin ETF, because he can't invest in China anymore. He can't go just spray and pray. Now it has to be strategic. And so, this is where I think the world is the next 5 years is going to be probably old school macro winners and losers.
So as you say, it might be that you get this great opportunity to invest in these stocks, these environments, these sectors, because inflation, the real fiscal policies that create inflation are still maybe another election cycle beyond the one this year away from us. So it doesn't feel like we're in the cusp of anything dramatic. Again, exogenous shocks apart, it doesn't feel like that's going to happen yet. And do you feel that
$2 trillion deficit it's definitely flowing through, but I'm actually shocked the inflation is not worse, to be honest, with all that spending. But that's the power of the disinflationary forces and the productivity boom.
Yeah, I mean, you can look at, I think it's the classic change in M2, and you see the change in M2 that we got post-COVID. Inflation should have probably been at 15 to 20%. It should have certainly been in the double digits. Now, obviously, comparing these, it's always lovely doing these charts, and it's always a chart crime to sort of go, there's M2 change, there's CPI change. But nonetheless, given the size that was in there, and a lot of the people who rightly predicted inflation, but they also expected that inflation to be a lot higher than the 9.1 peak that we got, based on the size of that M2 shock that we got on the upside. So you're right. There are those forces at play, or it certainly seems that way. And do you think, do you turn your sights to? We've talked about Japan, but do you turn your sights to any regions, stroke countries outside of the US for some of these opportunities? Because it feels to me that, whichever way you look at it, it's hard to actually come up with, Europe. What would I buy in Europe? It's apart from saying Europe's been a dog for so long, it's got to rebound. And as you say, China. Well, China, if it's still uninvestable because of geopolitical reasons, then I'm going to be nervous. Do you see any spaces out there? Any places? Any countries? India?
Yeah, I mean, Canada is an easy one. It'll be really interesting to see what happens after Trudeau, and it feels like things are. There's a choice to make there, which is, do you decide to be pro-capitalist or not? And they do have, some of the world's best natural resources on the ground. Uranium is primarily found up there, and Mexico is also another one. What happens in a world where you have autonomous trucking, and the cost of labor in Mexico is now cheaper than China because the demographics are shifting. So Mexico could be a massive beneficiary. They're also younger. I think they're like mid-30s on average. So you have really good productive years and cheap labor there. With you could have a whole reshoring to Mexico. Argentina is another interesting one. So there's a lot of different ones, but it's going to be in the midst of a war, and we're going to see. I don't think China is going to go down not swinging. They're definitely investing in some of these countries as well, but it's hard to pitch Europe. I got to say, like it's.
I gave up years ago. I gave up. I mean, God. You're right. It is. I mean, the thing is that actually in Europe, it's always been the case outside of the UK, but the best companies are still privately held. There is a reason why the German economy is bigger than the UK economy, but the market cap of the main index is smaller. Again, if you go to Sweden, if you go to a lot of, certainly Northern Europe, there are a lot of good companies, but they're still in private hands. So therefore, there isn't anything obvious around Europe. The argument for Europe always seems to be it's underperformed, therefore it's Europe's turn. But I remember hearing that about Russia from 1998 until today. So, that underperformance is no reflection on future opportunity. And then just finally, sort of thinking about sectors. So you're talking about the sort of decentralized sectors. Is there anything that, in terms of companies, there's the new companies. Do you see any sectors where existing companies are doing a very good job at absorbing new technologies or buying into them? So, for instance, healthcare with new developments in terms of longevity biotechnology. Do you see there's these opportunities? Because most people think crypto and very new specialist companies, many of you say of which are still held privately. But do you see any sectors where they are being dynamic and keeping up with trends in a way that actually a traditional investor could just say, right, that's a sector which is moving with the moves that we're seeing in technology?
Yeah, I think biotech is one that's really interesting. This is part of picking winners and losers. We're macro, so it's really hard to pick really good biotech stocks. But if you're just going to ask me in general, that Jensen Huang invested in Recursion Pharma. We don't own it, just caveat it. But there's a reason this guy has it. He is probably the expert in AI in the world. He invested in this stock. So this is an industry that is probably ripe for his productivity gains. And you could probably have if the FDA loosens up and, this first turning happens, a lot of the gatekeepers come crashing down, and you have data backed and you have AI that can back, things a lot faster. So that's another interesting one. I'd probably place a bet on if I had a biotech analyst.
I mean, I guess one of the dangers is, what if we all live to well through 100? I mean, doesn't that screw things up? Because, the whole idea is that you probably get the generational shift in wealth. There's the boomers, pass away, etc. And we're not a long way from that scenario ourselves now. But let's say someone said to me, actually, Roger, you can live 20 years more than you would have expected for your life expectancy. Suddenly, doesn't that change quite a few things? Again, do I stay in the labour force longer than most people would have expected? Do I have to rethink my investment horizon? Yes, I do. I mean, in some ways, one of the most interesting questions could be in biotech. If biotech is successful, it's not just investing in biotech, but it's investing in me being older for longer.
Yeah, exactly. It's there's lots of tangential ramifications on that. So it'll be interesting to see how.
Do you think that rather than have a East versus West war, we'll actually have a old versus young civil war type thing? Do you think that the unrest and what I mean by this is rather than that, and some of the geopolitical thing is a demographic thing that's now playing out in sort of the international scenarios. But do you think that actually there might be, and this is the geopolitics, which is because you've got the demographic imbalances in so many countries now, that's going to create the political changes that create the geopolitical tensions. So ultimately, is all of this actually a demographic issue that we've got that's now starting to play out internationally?
Yeah, I think these problems are all tied in hand of probably because of 40 years of globalization. But one thing I would ask you is like, are you seeing I think personally we're seeing a giant shift from the left to the right. It's clear that's kind of what's happening right now, and this is me being kind of a centrist, but I think you're going to probably have 40 years of conservatism. I'm noticing a lot more pro-Christian things, like the growth rates of like Sound of Freedom or movies tied to Christianity. People's values are changing here, and it's kind of try to be objective about this. It's not a good or bad thing, but I think that's largely if you were a kid in high school and you were told by an institution, for 2 years of your high school career that you had to just sit in front of a computer and learn, and you couldn't go to school, but your death rate on COVID was like 0.0001. You're in hindsight, you're probably thinking that was kind of a joke. And this is me. Like, I know COVID was a big deal. I'm not like trying to downplay it, but like if you were in high school and it's kind of like not necessarily the same thing, but Vietnam, you had a lot of distrust in the institutions for that generation. And, could that be where all the people who were in charge and the institutions were pretty left leaning, and I think that's pretty objective to say, and now the shift is happening. I think a lot of Europe largely is a political decision. If you had 30 years of kind of like moving to the left, and one of the things that Peter Thiel says, he says ESG equals CCP. And I think this is what I want to ask you is, in Europe, you're very pro ESG, generally speaking. And I think Europe has a decision to make. Are they going to be in the Chinese sphere of influence, or are they going to be, in the U.S. allied world sphere of influence going forward?
Yes, I mean, look, the one of the things that I think within all of this is that generally the world moved more centrist. So by the centrist, most people think of centrist as being slightly more leftish, certainly more liberal. I think where we are moving is that I think there's a ratchet effect towards the right. But as we're probably going to experience in the UK this year, there will be a rejection of the right because the right has been the incumbent through all the bad things that have happened. And someone just goes, get rid of them and get the other side in. The other side, Labour Party, happens to be less left-leaning than it has been for a long time. So we might go Labour, but that's because the public's just gone, oh my God, we've had how many years of Tories and Liberals, and they didn't really do that much. Most other regions had been slightly left-leaning and are moving that other way. So I think it feels like there's that ratchet effect, but actually I think there's a rejection of whoever was leading during the times of stress is being rejected. And it just so happens that, yes, there are probably more left-leaning governments through that period than right-leaning. We're one of the exceptions of that. But I think the world is just moving to that sort of, I think there's a realization that, and I've always said this, with socialism, etc., is that if you have a socialism type of thing, then capital dies. It looks good at the point of socialists come in, take the capital. It looks good for a couple of years. Capital dies. problem I have right now is that a lot of the right-leaning governments or right-leaning thinkers are actually just as happy to do left-leaning policies of yesteryear. I mean, the Conservatives over the last 4 years in the UK were more left-wing in their policies than Labour had been before them in terms of spend.
I think it's a demographic. Maybe it's a demographic thing.
Well, I think that's right. I think it is. So the fiscal spending is generally thought of as being a left-wing thing or left-ish thing. And yet fiscal is what everybody wants to do. I mean, everyone in the US, we'll spend our way out of this. Yeah. And so most people are not doing what Argentina's doing, which is actually going full on into, okay, let's make this right theoretically. But they're actually going, we're right-wing, we're anti-woke, and we're going to spend as well. So that's the problem we have is we move right, but we still have some very, very kind of spend policies because the younger generation, as you pointed out, as they come through, they're demanding that the inequality, generational inequality, regional inequality, just general job inequality, that's got to come to an end. Movement towards labour from capital. Movement towards labour from capital is left-leaning, but with a right-leaning kind of mentality on the social side. But on the economic side, it's more left-leaning, fiscal.
There's the irony, right? Like maybe that's the giant pendulum that you just caught there. I think that's spot on. But we'll see if it plays out that way.
It is, and it sounds like, actually one of the things we should be doing is with VIX where it is, and if VIX 20 is the new 30, actually maybe VIX, buying some of these, either VIX calls or maybe buying long-dated, low-delta puts is the right thing, because maybe volatility will have more of an opportunity to the upside than markets on the downside, because it seems that every time we have a big pullback, macro-prudential things come back in. We'll put a bit more capital in there. We'll do a few more BTFPs or whatever they're called. I mean, do you think people should pick up on a bit of volatility? Maybe longer term, because it feels like we get the bout of volatility and then they come in and suppress it, but you'd still need that bout of volatility for the policymakers to come in.
Yeah, I mean, it's tough. I think if you go out a couple months, it's probably what you could make money in the market go up with the VIX going up, VIX up, market up, because people aren't allocated. They're racing to get exposure. That could happen too. But yeah, I think it's probably underpriced around here. That's not a bad way to hedge, but at the same time, I don't see a lot of credit issues, so if you have global collateral, this is Michael Howell, but global collateral is going up, and the CDS on bonds is going down. That's massively positive for the liquidity cycle, and in that sense, the VIX might just keep putzing around down here. So, Maybe the thing to do then is, and I say almost every week, I'm the broken record on this, which is the old stock replacement trade. Buy your calls on the index, so you'll get some of the upside. Calls are cheaper than puts, etc. You've got your cash. Okay, some of that cash in the bank, you can earn 4%, maybe 5%. Maybe put a bit of it into some of these high volatile opportunities, like you've been talking about, the frontier markets or the frontier of decentralization. But you still got 6% of your capital in cash earning income. You've got a decent amount of calls, which will give you participation in the upside, and then go for frontier markets or the frontier concepts within the decentralized space. That's not bad. I like it, Raj.
Brilliant. I'm going to become a fund manager.
Yeah, right.
Great. Well, Tyler, thanks very much for having you on. Thanks very much for being on. Thanks for having you. Been great to chat to you. And I think you're right. I think active management. I personally feel this is a world where the opportunities are going to increase, having been, we've had one trade for 10 years, which was long bonds and long tech equities up until 2020. I feel a world where there's more opportunities, more choices, more differentiation, actually a good world for investors and active investors, not a bad thing. So I'm quite excited about the opportunities out there.
Yeah, me too. We'll see if it happens. There's a lot of capital concentrated in certain pockets. So if it gets dispersed, it could be a pretty interesting couple of years.
Brilliant. Well, thanks very much for your time. Good to speak to you.
Raj, take care.